Welcome to our detailed educational overview of the HDFC Life Guaranteed Income Insurance Plan. In this video, we will walk you through everything you need to know about this plan, helping you understand how it can support your long-term financial goals. So what exactly is the HDFC Life Guaranteed Income Insurance Plan? It is an individual, non-linked, non-participating savings life insurance plan. Non-linked means your returns are guaranteed and are not tied to the stock market's performance. It is a dual-purpose product that combines a disciplined way to save with life insurance protection for your family. Being non-participating means you won't receive a share of the insurer's profits like bonuses. Instead, all your benefits are clearly guaranteed right from the start. Its core purpose is to provide you with a guaranteed stream of regular income for a fixed period, a final lump sum payment and life insurance cover throughout the policy term. The plan works in three simple phases over the total policy term. First is the premium payment term, where you actively pay premiums to fund your policy. Next is the deferment period, which is a waiting period after you finish paying premiums but before your income starts. This period can even be 0 years if you want your income to start immediately. Finally, there is the payout or income term. This is the phase where you receive your regular guaranteed income payments, and at the very end, you also receive a final lump sum maturity benefit. Let's look at a practical example using Balaji, a 35-year-old. Balaji's goal is to secure a regular guaranteed income after 15 years. He pays an annual premium of 50,665 rupees for 15 years, which is phase 1. In phase 2, from year 16 to 30, he receives a guaranteed income of 90,553 rupees every single year. At the end of year 30, Balaji receives a final maturity benefit of 8,23,307 rupees in addition to his last income payout. Throughout this entire 30-year journey, his family is also protected by a guaranteed death benefit. The first major benefit is your guaranteed regular income. This is a series of fixed payouts you receive for surviving through the payout term. How is it calculated? It's a predetermined percentage of the sum assured you select at the beginning. This percentage depends on factors like your premium amount, your payment term, and your deferment period. You can choose to receive this income either annually or monthly, and you can even change this frequency during the policy term. Note that these income payments stop if the life assured passes away, at which point the death benefit is paid. When you start the policy, you must choose when you want to receive your income, in advance or in arrear. This choice cannot be changed later. Arrear is the default option. Payments are made at the end of each period, like the end of the year, and you receive 100% of the calculated income. If you choose advance, payments are made at the beginning of each period. However, the payout amount is adjusted. You receive 92% for annual payouts or 99% for monthly payouts compared to the arrear option. The second key benefit is the guaranteed lump sum at maturity. This is a substantial payout paid at the very end of the policy term, provided the life assured survives. You receive the full sum assured you chose at the start, and importantly, this is paid in addition to your final income installment. This benefit is payable as long as the policy is active and all premiums have been paid. The third benefit is protection for your family through a death benefit. If the life assured passes away at any time during the policy term, a life insurance cover is paid to the nominee. The guaranteed death benefit is the highest of a multiple of your annualized premium, 10, 7, or 5 times the premium amount, or the sum assured, or 105% of all premiums paid to date. A very important feature is that the death benefit is not reduced by any guaranteed income payments you have already received. You also get to decide how your nominee receives the death benefit. Option A is a lump sum, where the full benefit is paid in one single transaction, and the policy then terminates. Option B is the family income payout, FIP. This provides a larger total payout, 110% of the guaranteed death benefit, paid out in 60 equal monthly installments to provide regular support to your family. To customize your protection, you can add optional riders for an additional premium. These include the income benefit on accidental disability rider for monthly income after an accident, the Project Plus rider for accidental death or critical illness, the waiver of premium rider which covers future premiums if you face major health issues, the Health Plus rider for a lump sum on specific illness diagnoses, and the Live Well rider for various health-related benefits. Remember, the rider's sum assured cannot exceed the base policy's death benefit. Let's quickly look at who can join. The minimum age at entry is 30 days, and the maximum is 65 years. The policy can mature between the ages of 18 and 99. You can choose a policy term from 10 to 60 years, and a premium payment term ranging from 3 up to 15 years. Annual premiums start from 12,000 rupee to 24,000 rupees depending on your chosen term, with no upper limit on how much you can invest. If you need funds urgently, the plan offers a loan facility. It becomes available once the policy has a surrender value, typically after 2 years of premium payments. You can borrow up to 80% of the special surrender value, with a minimum loan of 1,000 rupees. The interest rate for 2024 to 25 is 9.5%. Just be careful. If your loan and interest exceed the policy's surrender value, the policy could be terminated. Life happens. So what if you miss a premium payment? There is a grace period, 15 days for monthly payments and 30 days for others, during which your policy stays fully active. If you pay your premium within the grace period, your policy continues. If you still don't pay and the policy hasn't earned a surrender value, it will lapse and all benefits will stop. However, if it has earned a surrender value, it converts to a reduced paid-up status, meaning it continues but with lower benefits. You can revive a lapsed or paid-up policy within 5 consecutive years from the date of the first unpaid premium. To do this, you need to submit a written application, provide proof of continued insurability, and pay all outstanding premiums plus interest, currently 9.5% for 2024 to 25. The company will then review and decide whether to approve the revival. If your policy becomes reduced paid-up, your benefits are scaled down based on the number of premiums you actually paid versus the total number you were supposed to pay. This applies to your death benefit, maturity benefit, and your survival income. For the income benefit, a paid-up value factor is also applied, ranging from 50% to 100% depending on how many years of premiums you completed. Please note that the family income payout option is not available for a reduced paid-up death benefit. It is paid as a lump sum. If you need to exit the plan entirely, you can surrender the policy for a one-time lump sum called the surrender value. This is possible after paying premiums for at least 2 consecutive years. You will receive the higher of the guaranteed surrender value or the special surrender value. Keep in mind that surrendering terminates the policy and all its benefits permanently. As a policyholder, you have important rights. First, there's a 30-day free look period to review your documents. If you are not satisfied, you can return the policy for a premium refund. You can also assign your policy, which means transferring your rights to another person or institution, like using it as collateral for a loan. Finally, you must nominate someone to receive the benefits if you pass away, and you can change this nominee at any time before maturity. When it's time to make a claim, you'll need specific documents. For maturity or survival benefits, you need the original policy document, a discharge form, ID proof, and bank details. For death claims, the nominee needs the claim form, death certificate, original policy document, and their ID. If the death was accidental, additional police and medical reports like an FIR or post-mortem report are required. Is this plan right for you? It's a good fit if you seek predictability and guarantees, are risk covers, have long-term goals like retirement or education, and value simplicity. On the other hand, you might look elsewhere if you want high growth through market exposure, have a high-risk appetite, need immediate liquidity, or prefer to keep your insurance and investments separate. Finally, a few important checks. There is a suicide exclusion. If death occurs by suicide within 12 months, the full benefit isn't paid. For minors under 12, full life cover only starts after the second policy year. Regarding taxation, benefits may be eligible for tax advantages, but laws can change, so consult a tax advisor. Lastly, This is a non-linked, non-participating plan, and the policy document contains all final terms and conditions. Don't rush into buying this plan. Take a step back and first understand your own financial needs. Think about how much risk you are comfortable with, the kind of income you'll need in the future, and the goals you are working toward. And before making a final decision, it's always wise to speak with a financial expert who can guide you based on your personal situation. Thanks for watching. Check out the video description. We've packed it with resources just for you. If you found this video helpful, please give it a thumbs up and share it with someone who needs it.